Okay, let us start. Okay, accounts. So when we refer to accounts, it means that we are referring to the specific names of an account. And in this, we will discuss the accounts under assets. Or the accounts can also be called name of account, or the most appropriate term is account title. Okay, let us start with assets. Okay, under assets, we will have an account called, oh, by the way, assets are resources of the business that have future benefits. So all assets that are resources of the business, and all assets have future benefits. Okay, the first one is cash. Okay, this is the first one because this is the most liquid. So when we speak of cash, we will have cash on hand. Cash on hand is the one actually in the possession of the business. Okay, if we're referring to cash in hand. And we also have cash in bank. This is the cash of the business that are deposited in the bank. And we also have cash equivalents, and cash equivalents include marketable securities and short term investments, like the investments that you made that the maturity date is within 1 year. So that's why it's a short term investment. Time deposit will fall under cash equivalents. Okay? And all securities that are only within 1 year will fall under cash equivalents. We will study later what is really marketable securities. Okay? So, some are now the general term being used instead of cash is cash and equivalents. So, the other type of asset that we're going to study is receivable. Okay? Receivable is that the obligation of the third party to the business. And the most common is accounts receivable. Accounts receivable are your collections from your customers because of the unpaid accounts in your business operations. So if you are in service business like LaSalle, if the student have unpaid tuition fees, and that unpaid tuition fees uh, from by the students to LaSalle is the accounts receivable of LaSalle. Some people are calling this as trade receivable because the receivable was generated from the trading business. So some may call this trade receivable. Another classification of receivable is others. All other receivables that will not fall under accounts receivable can be classified as other receivable. Next is supplies. Under supplies, supplies is a general term, but you have several supplies like office supplies, kitchen supplies, cleaning supplies, or you can just use this specific account if you have a lot of office supplies and a lot of kitchen supplies, especially for if you are in restaurant or baking, you have a lot of kitchen supplies. Or if you are in hotel, then you have a lot of cleaning supplies. However, if you want to lump this up in one account, then you can just use supplies. Okay? And another asset is prepaid expenses. These are prepayments made on certain type of expense, and the most common are for the rent and for insurance. For the rent, for example, today, September, and you are going to make advance payment for the rent for 6 months up to March, then that is a prepaid rent. And for prepaid insurance, if you will purchase an insurance policy for 1 year, and as of this time, if you have purchased it today, as of this time, you have not used or consumed or the policy has not expired yet because you have just recently purchased it and the duration of the policy is for 1 year, and then you have paid it, so it is the term or the account that you can use is prepaid insurance. Okay? Plus, this type of assets are subclassified as current assets. So what is current assets? Current assets are ones the company expects to convert to cash or use in the business within 1 year from the balance sheet date. All of this, cash and equivalents, receivables, supplies, prepaid expenses, qualify on the definition of current assets. Okay, another subclassification of assets is non-current assets. What is non-current assets? Non-current assets, tangible, intangible, and financial assets of a long-term nature. So when we speak of a long-term nature, we are referring to the useful life of that asset. And it has to have more than 1 year to qualify as non-current assets. Okay? What are these? These are building. So, equipment. So this is the general term being used in the business. So the business will understand that, oh, these are the common or standard account being used by the business. So equipment, what can fall under the equipment? Tractor, machineries in the factory, bulldozer, things like those, or even the small thing as some are using the equipment account for tools. Okay, so it depends. Okay, but it is more appropriate to use tools. Okay, so it depends on the magnitude and the materiality of the item. Okay, so this lawn mower, even a small item, and then that can be classified as an equipment. Okay, we have furniture and fixtures. Okay, so like for the desk, tables, cabinets. Okay, and what else can you think of that will fall under this? So all type of furnitures. Okay, so this is the account being used by the business, furniture and fixtures. Okay. Computer. Okay, now a lot of companies have the computer account. During my days, we don't have an account computer, okay? Because we have no computer at that time. Okay, what else? Vehicle is also a common account name in the business. Okay, so vehicle can include buses, trucks, cars, service vehicles, SUVs. So all of this can fall under vehicle. Okay. Plus, it is also this non-current assets. It is also called fixed assets or property, plant, and equipment. So actually, the property, plant, and equipment, that was the previous subclassification of non-current assets and also as fixed assets. Before non-current assets, the subclassification is fixed assets. So they are all synonymous: fixed assets, property, plant, and equipment. Okay, it means non-current assets. Okay, class? So remember this, class. All assets, all of these assets, cash, receivable, supplies, prepaid expenses, building equipment, furniture and fixtures, computer, vehicle, are expected to have a debit balance. Okay? Let's move on. Now, let us discuss liabilities, the account under liabilities. Okay? So, liabilities is an obligation of the company. And the first subclassification of liabilities, similar to assets, current liabilities. If assets has current assets, liabilities will have current liabilities. What is current liabilities? Current liabilities are obligations of the business that need to be paid within 1 year from the reporting date. Okay? Its maturity is within 1 year. So what are examples of our current liabilities? Accounts payable. What is accounts payable? These are obligations with suppliers, vendors, landlords, agencies. So if you have purchased or you bought something, like you bought something from your supplier, then you haven't paid it yet, or the suppliers gave you certain number of days to pay it, then that is your accounts payable. You are obligated to pay the supplier within a certain period of time. So that will be classified as accounts payable. And accounts payable is incurred in the normal operations of the business. Okay? So next is accrued payable. Some are calling this accrued expenses, but I prefer to call it accrued payable. Accrued means increasing, to increase your payable. So you are actually increasing your payable because you want to record expenses, additional expenses. Okay? So accrued payable is used if the expense to be accrued is for the current year and the other portion is for the next reporting period. For example, salaries of 100,000, but that salaries of 100,000 falls into two accounting periods. Okay? You are preparing a salary from the period December 24, 2019, and the salary covers up to the period of January 5, 2020. So, this salary covers two accounting period. If the business accounting period is calendar year, so the most appropriate account that you have to use is accrued payable, or it means that you are accruing the salaries of from 24 of December up to December 31st for that particular period, the first reporting period. Okay? Next is notes payable and loans payable. These two, notes payable and loans payable, are obligations with banks or with financial institutions for the borrowed money. Okay. Accounts payable are obligations with suppliers, vendors, okay, like the Meralco and the things that you have purchased on account. Okay? You receive a particular product from your suppliers. Okay. Notes payable and loans payable, you will use this if you are borrowing money from the bank. So you cannot use the account title accounts payable for the borrowed money. The appropriate account title is notes payable and loans payable. Okay? Loans payable is the standard account title for loans. However, if the loan is documented by a promissory note, the notes payable account is more appropriate to use. Okay, so if there is a documentation, there is a notes, a promissory note, then you have to use notes payable. Usually, the term of notes payable is within 1 year. So the notes payable has a connotation that it is a short term, 180 days, 240 days, 30 days. So it has a connotation that it is within 1 year. So for loans payable, the normal loans payable has more than 1 year. So only the portion of the loans that will be paid within the current reporting period will be, or within the year from the reporting date, will be presented as current liabilities. And the rest of the loan will be presented as non-current liabilities. Next, unearned revenue, and this is also called deferred revenue. These two terms are synonymous, unearned revenue or deferred revenue. This represents the advance payment from customers on services or on sales. So it means that you receive cash from your customers, but you have not yet delivered the services or the sales. Okay? So it is recorded as liability under unearned revenue because the business has an obligation to the customer to provide the services or sales. Okay? And these liabilities, all of these liabilities, the normal balance is credit. Okay? Let's move on. And now we are going to discuss the continuation of liabilities, and at this time, the sub-classification of non-current liabilities. Non-current liabilities are long-term obligations of the business. Okay? The maturity dates are more than 1 year from the date of the reporting period. What are some of our examples? The long-term portion of the loans payable. Okay? The portion of loans payable that is due after 1 year. And the most common is the mortgage payable. The mortgage payable provides the understanding that it is of a very long term. This type of loan has a longer term and require an asset to be attached as a guarantee on the loan. So if it is a mortgage payable, meaning you are attaching an asset to secure the loan, or you are mortgaging. So if you are mortgaging your land title, then the bank is holding your land title, and it will only be released to you if you have fully paid the loan. Okay? So usually land title or any fixed structure are used as the guarantee or collateral for the loan. Okay? And this accounts will have a normal balance of credit. Let's move on. Now, let us look at the specific names of an account or accounts under equity. Equity represents the total capital investment from owner plus accumulated profit and less accumulated loss. So owner's capital is the amount of capital invested by the owner. So owner's capital is the account being used, okay, for the investment by the owner. Profits of the business increases owner's capital, and losses of the business decreases owner's capital. Okay? So the normal balance of owner's capital is credit. Okay, class? It is a common practice that owner uses company's assets for personal, which is considered withdrawal of capital. Hence, the use of business assets for personal by the owner is recorded in the account owner's drawing. Okay? So it is recorded as owner's drawing. Owner's drawing decreases owner's capital. Hence, owner's drawing will have the opposite balance. If owner's capital is expected to have a credit balance, then owner's drawing is expected to have a debit balance. Okay? This type of opposite account is called contra account. So we are introducing the contra account. We will discuss all other contra accounts later. So owner's drawing, the normal balance is debit because it is the contra account of owner's capital. Okay? So let us now present all the accounts that we have discussed in the accounting equation. Okay, we have assets here. We have the sub-classification current assets. And we have cash, accounts receivable, office supplies, prepaid rent, prepaid insurance, and there are non-current assets, building, equipment, furniture and fixtures, computer, vehicle, okay? And we expect all of these assets to have a debit balance. Plus, there are more types of current assets and non-current assets, okay, that the businesses are using. These are just the most common, okay? And for liabilities, we have current liabilities, accounts payable, accrued payable, deferred revenue, notes payable, loans payable, and non-current liabilities, loans payable long-term, and mortgage payable, and on equity owner's capital. Okay, and the contra account of owner's capital, which is owner's drawing. All of this, except for owner's drawing, all of these liabilities and equity have or will have a credit balance. Owner's drawing is a contra account, so it will have a debit balance. Okay, class? So remember, class, assets, liabilities, and equity are real or permanent accounts. Why it is called real or permanent accounts? It is real or permanent accounts because the balances of these accounts are since the start of the business. Okay? So these accounts, assets, all of this, current, non-current, all of these accounts, all these asset accounts, and all the liabilities accounts, and non-current liabilities accounts, and the owner's capital, and the owner's drawing are called permanent accounts or real because their balances are from the start of the business. Okay, class? Questions? Remember, the only stupid question is the one that goes and asks. So please send your questions to the general page of MS